We recognize that there's been continued angst around global trade uncertainty, specifically as it relates to tariffs. Given that, a little change of pace today, no charts and graphs. Rather, I wanted to take this opportunity to address how we're dealing with these uncertain times. So let's first start by having another conversation around tariffs. Certainly, the efficiencies of trade are best met when one country produces and exports what it is best at and imports what it cannot produce as effectively. Naturally, this entails that tariffs are disruptive and inefficient. Likewise, as we touched on in our 2025 outlook, the transmission function for tariffs does not follow a linear path. Yes, prolonged tariffs are likely to lead to higher inflation, but the end result could include retaliatory measures, reshoring of supply chains, and alignment of trade with new partners. We continue to believe that in a North American context, particularly with the integration of US and Canadian supply chains and the US reliance on Canadian crude and critical minerals, that tariffs are a means to an end and not the end. We previously highlighted the need for Canada to reassure the US it was taking issues such as border security and defense spending more seriously. And once they did, this did result in a pause in the initial tariff announcements in early February. Tariffs that are short lived, for instance, 1 to 2 months, will ultimately have a drastically different impact than those lasting 6+ months. Ultimately, the tariff conversation is one that is not stagnant and will evolve over time, especially with the president that we have in charge down south. So we find ourselves in an uncertain environment. And yes, we do take the threat and potential impact of tariffs credibly. So, how are we dealing with it? Well, first, certainly we do not condone attempting to time the markets in the advance of a quote unquote potential tariff related decline. Timing the markets has proven time and time again to be a futile effort and one that is detrimental to long run returns. We've seen this firsthand as recently as 2023, when going into the year, the majority of global strategists and economists were predicting a prolonged recession. In the subsequent 2 years, US equity markets have returned over 20% in each year. Philosophically, we believe and have believed in taking a long term view. In our 2025 outlook, we reiterated our belief in a volatile year ahead. However, we continue to embrace a multi year view to all of our investment decisions and focus on the predominant driver of equity market returns, fundamentals, and economic growth. The US and Canadian equity markets are still positive this year, as are international markets, despite the anxiety that news sources continue to spout. So, if that's not a testament to the difficulty in trying to time markets, then frankly, I don't know what is. So instead, we're focused on managing risk and keeping you invested. So, how do we do this? Well, from an asset allocation perspective, we continue to assess what tariffs could mean more broadly for financial markets and asset classes. For example, will tariffs ultimately impact the global reliance on the US dollar if countries divert trade away from the US? Will different geographies be net beneficiaries or losers from a potential reorientation of global trade? What is the potential impact of tariffs on asset class correlations? So, this is just an example of some of the questions that we continue to ask ourselves to inform our long run views. From an equity selection perspective, we have taken the time and continue to take the time, especially as we're getting more color now from Q1 earnings, to assess the impact of tariffs on each of our holdings. For every company we have exposure to, we've examined their reliance on foreign demand for their goods and services, or significant inputs that they procure from foreign countries. Our equity research process is rooted in allocating to high quality businesses with durable competitive advantages and pricing power. Ultimately, we believe that these will leave these entities better situated to weather potential cost increases from tariff related increases. We are also overweight areas that are less reliant on foreign demand or production. This includes areas such as healthcare services and pharmaceutical companies with locally sourced production, service-based entities such as IT and communication services, and exposure to select areas of real estate and utilities. And as Darren and I touched on in our outlook, we continue to find opportunity in key secular themes that we believe can support continued earnings growth through bouts of volatility. We also acknowledge the sensitivity of certain economies, such as emerging markets in Europe, to tariff threats, and have been underweight those economies in a global asset allocation context. From a Canadian lens, we are very mindful of the potential drag from long lasting tariffs, as it will certainly be greater than that felt in the US. However, as mentioned, we do have belief that both countries will ultimately be able to find a resolution, especially with upcoming USMCA negotiations. Ultimately, entity specific outcomes will be dependent on the substitutability of their goods and the ability to reroute trade globally. Our Canadian portfolios are overweight entities exposed to the domestic rather than the US economy. However, we'll continue to carefully watch the tariff conversation unfold, as a prolonged downturn, if it were to occur, could reverberate across the entire economy. So, to close, we take the threat of tariffs seriously. Behind the scenes, we are being more active than ever to ensure our portfolios are aligned to this changing environment. We continue to stress the importance of taking a long term view, and it is one that, when is taken, has proven time and time again in being successful. As a final closing thought, and as always, please reach out to the team if you have any additional queries, and let's hope for a little less snow to end the winter here in Ontario. So thank you all very much, and have a great rest of your day.